With sky-high valuations, record debt, recession signals, the possibility and the probability of this bull market ending in 2025 is higher than ever. But it hasn't felt that way because it's been said for a while. Are you prepared for what may happen next that no one is expecting? So let's start with my favorites. Valuations. The S&P PE ratio is now above 30, far above the historical average. And the 10-year PE is at 38 point something. The only time it's been higher was during the tech bubble when it hit 44. And tech's magnificent seven, companies like Nvidia and Tesla, are dominating the market, eerily similar to the dot-com crash of the late 90s and the Nifty 50 of the 1970s. Here's the reality. High valuations don't guarantee a crash tomorrow or any time in the near future, but they can potentially limit the upside and increase your risk. Polaroid, for example, lost over 90% of its value after the 1970s crash. Today's Nvidia and others are priced as if infinite growth is a certainty. History shows that that never is the case. As a principle-driven investor, I want you to focus on fundamentals, not hype. The higher the valuation, the riskier the bet. Another issue we see is the increasing debt and potential refinancing squeeze. There are now record debt levels across the board. Corporate debt has topped at $11 trillion, and rising rates mean that companies and consumers are going to have to refinance at significantly higher costs. It's more of an issue for companies because most companies take on shorter-term debt levels, 5 or 7 years, while consumers, when they're buying a home, will usually lock in for 15 or 30 years. You have to remember that consumer spending makes up almost 70% of U.S. GDP, but rising inflation and high interest rates are eroding real wages. Consumer debt is currently at $17 trillion, and credit card interest rates are over 20%. Spending is likely to contract because of this. Now you might be thinking, why does this matter? Well, here's a historical parallel for you. Before the 2008 crisis, unsustainable borrowing masked the deep economic weaknesses. When the bubble finally burst, spending dried up, deepening the recession that we had. Because remember, consumer spending is 70% of GDP. Weak consumer demand is a major red flag for economic growth and for the markets. Squeezed cash flows mean defaults could spike, earnings could take a hit, and stock prices could tumble. If you're going to buy individual stocks, here's my advice. Look for companies with low debt, low leverage, and strong cash flow. These will be the survivors if things get rough. Another issue we're seeing is that global markets are also being strained by these geopolitical conflicts that keep popping up everywhere, from US-China tensions to the ongoing war in Ukraine. Rising energy prices and supply chain disruptions add to this pressure. During the 1970s, geopolitical shocks led to stagflation, which is a toxic mix of high inflation and low growth. Could we be heading for something similar to that today? Now, even if that does happen, I want everybody to remember, the boom that occurred in the 1980s and 1990s, yes, there may be stagflation for a while, but that pent-up demand will eventually get unleashed at some point in the future. And remember, you're a long-term investor. You're not a short-term investor. But let's talk about that yield curve. This is a statistic that should grab your attention. Every single recession since the 1950s has followed an inverted yield curve. And guess what? The yield curve has been inverted for over a year now. This isn't just a guess. It's one of the most reliable recession signals in financial history. Now, guys, recession doesn't mean doom. It means opportunity. I want to reframe the way in which you think. Crash and recession seem scary, but they're opportunities. Every past recession, every past crash looks like an opportunity. If you watch my stock analysis videos, you'll hear me talking about price versus value. Often, I'm adding stocks to my watch list, waiting to buy great companies below their intrinsic value, which I consider to be a great price. Prepare now by creating your watch list of high-quality stocks that you'd love to buy at a discount. And our software will notify you when they've hit the price you want. Now, a question I get asked often is, are we starting to see a bubble in AI stocks? Okay, so before I answer that, let's talk about the AI frenzy. NVIDIA's PE ratio is hovering around 100. Guys, this is a $3 trillion plus company. Does it sound familiar? Well, it should. It's reminiscent of the speculative frenzy during the dot-com bubble. Don't get me wrong. Innovation is and always will be exciting. But as an investor, not a speculator, It's not about just finding the next big thing. It's about paying the right price. And if you think that the current price for every company out there is the right price, then no price will be too high for you. Trust me on that one. As a principle-driven investor, I want you to avoid buying into the hype. Stick to fundamentals. Excitement fades, but good investments last a very long time. Finally, let's talk about cycles. Guys, there are 3 guarantees in life: death, taxes, and cycles. This market has been in a prolonged bull market since mid-2020 after COVID. Historically, long bull markets, especially the ones that hit these kind of valuation levels, end in dramatic corrections as investor complacency sets the stage for reversals. Valuations eventually matter, and when they matter with a vengeance. Here's another historical parallel for you. The exuberance of the late 1990s led to a 2000 collapse. The NASDAQ 100 hit a peak in March of 2000 and did not hit that level again for another 15 years. The NVIDIAs of 2000, Cisco and Intel, have not hit their 2000 peak prices. You were considered dumb back then if you didn't have those stocks in your portfolio. Guys, does that sound like today? It sure does. And guys, this isn't the only bubble that we've said will end poorly. We talked about the EV bubble. Ended very poorly. Yes, Tesla continues on, but remember all those other companies that were going to absolutely match Tesla went to nothing. Cannabis, same thing. Is this all adding up to be a market correction? High valuations, record debt, geopolitical tensions, and a slowing global economy are all converging. Markets tend to sniff out cracks before they're visible to the average investor. Could we see the market correct and usher in a bear market? Maybe. Nobody can predict the future with certainty, especially in the short run. But the warning signs are hard to ignore. The key isn't to fear the downturn, it's to prepare for it. When this bull market ends, there will be an incredible opportunity rather than a catastrophe. This is when principle-driven investors thrive. Your focus then should shift to finding businesses with strong cash flows, low debt, and prices that are selling below intrinsic value. While others panic and sell in fear, I would strategically deploy capital buying high-quality companies at discounted prices. Patience and discipline are key. Wealth isn't built by following the herd, but by making calculated moves during downturns. For me, market crashes are a gift, and staying calm and sticking to proven principles is how you come out ahead. Valuations continue to get worse and worse and worse. And it makes you feel short-term excited to see your stocks going up. But remember, we're principle-driven investors. We don't let the market price in the short run tell us if we're right or wrong. If you could buy Microsoft tomorrow for $150, would you do it? With today's stories, absolutely. But I want you to remember another thing. If Microsoft were ever to sell for $150 or the equivalent of that today, the stories following Microsoft would make it seem like a terrible investment. Adobe is down big time. And I just heard the other day people saying to me, Paul, Adobe is not going to exist anymore because of AI. Wow. Adobe is going to be one of the best benefactors of AI. They're already taking advantage of it. But look at how news follows the stock price. This has been time and time again. That's the key to our software. It helps you look at the fundamentals and look at, are fundamentals getting better, or are they not as bad as people seem? Are they not as bad as the story is telling? That's what I want you to learn as a disciplined investor, as a principle-driven investor. The bull market may be running out of steam, but remember, market downturns don't destroy wealth. Going at it alone and making bad emotional decisions is what's going to destroy wealth. Building wealth is when you don't look at market prices and look at intrinsic value and buy when the market gives you that opportunity. Navigating these markets alone will leave you vulnerable to fear, emotional mistakes, and missed opportunities. And that's why we have the Everything Money community, and that's why it was created, to bring together like-minded, principle-driven investors who are ready to seize the next bear market as their golden opportunity. Don't face this uncertain market alone. You can't run from the next correction, and you can't afford to stop investing. Join our community of principle-driven investors armed with all the same tools that I use every single day, and where strategies are shared so that everyone thrives when everyone else is panicking. Don't be like the other 99%. I know you at home know that you're not one of those people. So click on the link in the description below, join our community today, and let's prepare to take advantage of what's coming together. You'll be surely glad you did. Thank you for your time.